Hey, Renter Retires, it's Adam Schroeder here with another episode, joined as usual by Zach Lemaster, the founder and CEO of Renter Retirement. We're happy to be joined today by Kevin Amolsch, the president of Pine Financial Group, host of the Real Estate Educators podcast, and best-selling author of 45 Day Investor, How to Buy an Investment Property with Nothing Down in 45 Days or Less. Kevin, thanks for joining us today.
I'm so happy to be here, guys. Looking forward to the conversation and doing what we can to help your listeners.
All right, so we're going to start the same place we always start, and that is tell us about your first real estate deal and why on earth you decided to do it in the first place.
Oh, gosh, my first one and why I decided to continue after this one. So my very first one, it was a primary. I turned it into a rental, like a lot of us, right? So I moved out and I kept it as a rental. What's interesting is I didn't have any money for a down payment, so I took out student loans, which I didn't need for school, and I used that as a down payment on my second property. And that's what actually allowed me to become a real estate investor and my first landlord. What ended up happening, though, is the mistake, sometimes I'll get asked, like, what's your biggest mistake? Well, this might be it, because I didn't screen the tenant. I was just thrilled someone was going to pay me to live in my place, right? So I moved the tenant in, and it was a complete train wreck. I mean, everything you could think of, like an illegal business was run out of there. They had like running a black market on firearms. It was totally infested. Everything that could go wrong went wrong, and I had to go through the eviction process. So my very first tenant, my very first eviction, and I stuck with it.
So with that, why did you invest the second time? I mean, most people would have sold that property so fast and run away and been like, well, real estate doesn't work.
It's like you guys and your listeners, man. We're looking for something bigger and better. It's our why. So as long as you have a really, really strong why, I think it's impossible. I firmly believe this. It's impossible not to succeed. So if you have your goal and you have your target and you're going to do whatever it takes to get there, then a setback like this isn't going to stop you. So I was highly focused on that and not what was happening in the current environment.
That's interesting, Kevin. You talk about, I think that's an interesting twist, actually, using student loan money instead of for education, which could be argued if that's a true investment or not, is to actually use it to buy an actual investment, a rental property, right? I mean, I just
talk to your lender about whether or not that's allowed.
Yeah, I mean, sorry, I'm blowing that. I think probably, you had to close that loan and have it seasoning, and your I don't know about back in the day when you bought it, but it's certainly now in seasoning for 2 months, so you don't get too many questions on where the money's coming from. But I think that's kind of funny, as I think back about where I took out, hundreds of thousands of dollars for actual student loans that had a high interest, and for a degree that I don't even use now. I would have been way better off trying to buy investments with that. But to your point about why, what was your why? Can you share that with us? So what kept you going?
Yeah, so I lost my mom when I was 9 years old, and my dad raised me and my brother and my sister, and he did it all by himself. He was at all my soccer games, went to all the practices. He was just there. I don't know how the hell he did it. But one thing that he gave up in this process was his retirement. So he didn't save money. He didn't have a way to actually retire from a job. So my why was to retire him.
Nice.
Which I did. I bought him a house and free and clear. He has no mortgage, no expenses, and he's able to just enjoy the last bit of his life here.
And that's, I mean, wow, that's super impactful, right? I think that's a big, no one that is in this game, I realize this is, and we deal with investors on a daily basis, but no one is here just because they want to be filthy rich, right? Or like it's the why, because that's really the driving. It's a always some level of self-service. It's always about like creating a lifestyle, helping out family, being in a position where you can be there both financially, but also just time involved with the people that you care about, right? That's what keeps you driving through those difficult times. And certainly I think that speaks to your situation and your character, Kevin. So thanks for sharing that with us. But let's peel the onion a little bit further, if you don't mind. But like, why real estate though? If you had this terrible experience with this tenant and you're like, man, I want to provide this retirement picture for my father who sacrificed his own retirement for us and help. Like, how did you know that real estate was the ticket to get there, and what kept you going, and when real estate specifically?
Yeah.
Because you could have done other things.
You could, I mean, yeah, of course. And, you can get rich other ways and probably much faster. Real estate, what I've learned isn't necessarily a speed thing. You're not going to get super wealthy super fast. But what I've learned is, and I knew this earlier on, I just knew it. You could get rich in real estate no matter what. You can make mistakes and times won't fix it. Like, this is the only thing that I know that will guarantee wealth. So I decided to stick with it, but it wasn't necessarily just the long-term wealth that you create with rentals and that kind of thing. Because look, rental properties, you got to have a lot of them to replace an income, right? It takes a lot, but over time, it's just going to build your wealth. You will be rich if you have that. But real estate also allows you to generate large amounts of money quickly through flipping or wholesaling or other strategies that isn't necessarily holding on to the asset. So it created exactly what I was looking for to hit the goals I wanted.
So, yeah, real estate is a guaranteed path to wealth. No doubt about it. I love that you explain that. But you do have some bumps and bruises along the way. But if you just,
of course,
I mean, if you just buy, what's the easiest way to become a millionaire? Buy $1 million worth of real estate, right? And let someone else pay it off for you.
That's right.
But then the one thing you didn't add that I'd like to is the ability to leverage real estate. You know what I mean? And also then the tax benefits, which we obviously talk about. You couple all those things together, and it's like, it doesn't happen overnight, but also doesn't take a lifetime to build wealth, and it is the most predictable path to wealth. But sorry, Adam, I cut you off.
Yeah, I was going to ask, we talked about the why just a minute ago, and you mentioned, your dad's retirement. Well, you retired him. So how did you find your next why?
So the tricky thing about a why is we all want freedom, right? And you think about freedom and what is that? And this is cliche, but it's what you want, when you want, with who you want, right? So we all look for that, but really, is that what you want? I mean, if you really peel back the onion, to use Zach's term here, is that really what you want? And what I typically find is that's not true. What we really want to do is something bigger than us. What's impactful? What's the legacy? How can we improve the lives of other people? I think most investors are in this business. That's their why. They just haven't identified that yet. So if you can peel back and figure out what exactly it is that you really want to do, I think that's what's going to produce the wealth for you. For me now, it's kids. I see kids and I don't know where this came from, but I see kids that don't have a fighting chance. They're growing up in homes, single parent, drugs, alcohol, and they're on the street, man. And they don't have the same upbringing that I had, where I had a parent that was just always there for me, right? So I want to help them. So I do things with the Boys and Girls Clubs and that kind of thing. So that's my why now. I just want to make a difference in the kids' lives.
Nice. So did you, how has your investing style changed over time? Because obviously you didn't just keep taking out student loans and buying homes. Yeah. So how was your investing journey, progressed?
Yeah, and I should clarify the student loan thing that I'm always thinking about how can I do it, not it's how can I do it, not if I could do it, right? So that was just the solution to that problem at the time. But I had school paid for because I was in the military. So I was in a lucky position to have the ability to get student loans that I didn't even need. Not everybody is in that position, right? So for me, after I did that first one, I needed to accelerate, because I could do that once every couple of years maybe and just slowly, but I wanted to buy a house or 2 houses every single month. So what I ended up doing is learning how to do owner financing and creative financing strategies. So what really took off for me, Adam, to answer your question, is lease options. And that's what I wrote the book about. So it's really how to do a lease option, get in with very little or no money down, no risk. I could teach how to virtually eliminate risk with this strategy. And then just get those option payments, get that monthly cash flow going. And from there, I went into more creative, wraparound mortgages and subject twos. And eventually I discovered that my true passion was the financing side. All of that creative stuff, it has everything to do with the money. How are you going to finance the project? So I got into the financing side and I started raising private capital. And now we raise money and we lend it out to other real estate investors.
Let's talk about creative finance a little bit. And we've covered this pretty extensively in the past on with some other people in the industry that do a lot of creative finance. But things like subject to seller finance, lease options, these are all ways that you can essentially either take over someone's mortgage, where they could be the bank. We're looking at buying some short-term rentals right now with owner financing on scenarios where people, it wouldn't make sense to buy with a traditional type of loan, be with a high interest.
Very common right now, right?
And yeah, and depending where they're at in their investing, or a lot of these owners have a free and clear property. They don't maybe want to take the tax hit on selling it all at once. They're also older, looking at like residual income and retirement type of picture. And maybe they're battling a property that they got to do some maintenance on, and they don't really want to do that. So we can come in and take over that property. They can be the bank. We can have a low interest rate or whatever, that sometimes buy with very little money down. In most cases, we do put some capital down, but it's less than what a traditional bank would be. But that's just a creative way to potentially scale, and that's one of many ways. I mean, we all run out of capital for down payments, but walk us through a little bit, Kevin. Like, what is really the idea with creative finance? I think in most cases there's really like three main acquisition ways, but I'd like to hear from you. We talk about seller finance, subject to, where you're taking over a mortgage, and lease option, where you're not actually owning it, but you're having a lease in place with an option to buy. And then we have some people that will, do a takeout strategy where, they'll actually find a tenant that will buy from them, and they'll be on a lease option, and they could wrap that or whatever. But talk to us a little bit about owner for like big picture. What's the strategy with that? And I mean, did I cover majority of things? Did I miss anything there?
Yeah, if we're talking about just the creative financing world, I would put, some private capital into that category. I would put partnerships into that category. So there's lots of different ways that you can enter into a transaction with very little or no money. So I know you're putting a little bit down now, but when I was in college, I didn't have it to put down. I couldn't do that. So I had to find ways to do it without it. And subject to and lease options were the two that I really targeted. And it all came down to their motivation. So are you motivated enough to sign the deed to me without me paying off your loan? So you said you've covered this on your show before, but quickly, a subject to is literally getting the deed to the house and leaving the loan in place, and I just start making the payments. So I take over the payments on the loan, right? It's very risky because if I default on that loan, if it goes into foreclosure, that's not my credit. I didn't sign on that debt, right? That goes on to the previous owners. So they have to really either trust you or be super motivated to do that. The lease option, they don't give up full control, right? They still own it. They're only leasing it to you for a period of time, and then you have the right to buy it. It's the option to buy it within that window. So if they're not as motivated, I'd go to lease option route. If they're super motivated, I'd try to get the deed.
Yeah, as far as like subject to, and the big thing with subject to and seller finance, which is usually where someone, maybe they're not in like a hurt position, they have equity in the property and likely no mortgage. And so that's just like how you can structure for them where it makes sense from a tax and retirement picture, but they're not someone who's like behind on their mortgage, potentially losing the house. There's not as much pain there potentially in that scenario. These are all like tools in your toolbox to offer, I think, a seller, right, to get the deal done. And you're being creative based on the situation at hand. But let's focus a little bit on subject to. What I like about seller finance and sub to is you actually own the title on the property, or you're actually the owner, versus lease option, you're not. That also means, guess what? Now that you're the owner of the property, you can take tax benefits, from that, from being on title, which is really important if that plays into your plan. But how do you build trust? We won't spend all day talking about sub to and creative finance, but just to hear from you, because there's different opinions in the industry. How do you build and cultivate trust with someone, and prove to them like, hey, this is a business model. I've done this multiple times. I'm going to pay off your mortgage. But how do you build that trust and convince someone to do that? And then what are the logistical steps you follow where the bank doesn't, like, they're not focusing on this? There's not the due on sale clause, whole things where it's, is it a servicing? You're paying the mortgage through a servicing company. Can you walk through those two aspects?
Yeah, so I'll start with the trust, and then you might need to remind me of that second question.
I always do that. I give people 1,000 questions, but go ahead.
Due on sale clause. But so the build trust, if you're thinking about that or if you're concerned about it, you're already lost. It's definitely a mental game, and you need to go in there with confidence. So it's not credit or cash, it's credibility, right? So you go in there and build that credibility. And I would always go through a very specific 5-step sales process. So my very first step is to go through the acronym FORM, FORM. So I talk about their friends and family. I talk about their recreation. I talk about their occupation. And then I go into my message. So I will talk about all three of those things before I even get close to talking about the transaction.
And what do you mean talk about those things? Are you asking them about that? Are you building a rapport? Is that all that is?
Exactly. You want to build bridges of similarity to build that trust, that like and trust, right? That's what we know in sales. People do business with people they like and trust. So when I go into a house and tour the house, typically they're living there. So it's very easy. There's pictures, there's things around that you could use as props, I guess. And you can just say, oh, who's this in the picture? All right. So I'm thinking about friends and family now. Like, who is this? Tell me about this person. And very open-ended questions. And it's just question after question. I'm not talking about the house at all. The purpose of my tour of the house isn't to look at the house. It's to build that rapport.
Yeah.
And then once we get at the table, typically it's a table, maybe it's a living room, negotiate several on the back deck, but wherever they feel most comfortable, they'll take you there. And then that's when you get into the rest of the sales process. Right, so it's very, very important not to skip that first step or you won't get the deal.
So friends and family, occupation, what was the R and the M?
Yeah, form. So FORM, friends and family, occupation, recreation, and message. So that's how you can learn it. Different sales trainers will teach it different ways. M could be motivation because you want to dig into what their motivation is. I just learned it as your message. So you want those three before you get to your message. That's the idea. What's that? Yeah. Thanks for inviting me over. Do you mind showing me around? Oh, who's this in the picture? Oh, what I see a basketball, or you like basketball, or whatever it is,
That's so important. And I think that, listen, so a lot of times, and this is in any business, right? But in real estate sales and anything, so many people just go into conversations talking too much.
They try doing it on the phone.
Yeah. If you just shut up and listen and, ask people out questions, this is like if that's just relationship building 101. If you want people to like you, ask them about themselves. Don't tell them about you. Ask them about them. They like to talk, right? I was going to share a personal story on since we're visiting my wife's family, but right now, but I won't.
Nope, we don't want to hear it, Zach. Not interested in this story.
I kind of did.
Another episode. No one cares, but it's good to ask people questions about themselves to get them talking and be genuinely interested, right? Don't ask them a question and then leave the room.
Yeah, here's another piece. I gotta get this in quick because this would help me tremendously. So I talk about credibility. You got to have a reluctancy. You got to be reluctant to want to buy the property. You want them to sell you. Which there's very specific strategies on how to create that or craft that language. But one of the best ways to do it is to have a lot of appointments. If I'm meeting 5 or 6 people in a week's time, if I screw one of those up, it's not a big deal. So I'm not worried about it. So it's just a number of leads and a number of appointments. Then you just automatically, it's like organic. You have the confidence when you go in, if that makes sense.
Yeah, create the lead funnel in. I thought you were initially talking about the perception of being busy and having appointments with the individual. I'm sure there's something with that, but having actual appointments and leads, it's just a numbers game, right? It's just like negotiating deals. You never want to be too emotionally attached to anyone because, it should just be a numbers game. Second part of the question was around the bank, and this is probably an easier question. Is this servicing the mortgage so the bank doesn't raise questions on why someone else is paying the mortgage now? How do you do that?
Yeah, so quickly, the due on sale clause is not illegal. There's no due on sale jail. What it is a clause inside the deed of trust or the mortgage that says if you sell the property, we may or may not call the loan due, which basically pay me all my money back if you sell the property, right? So they may or may not. It's so rare. I have a buddy down in Colorado Springs that has done close to 1,000 of these. I don't know what the number is, but it's several hundred. He's had 2 called. I'd never had one. Most people I know have never had one called. So it's not that big of a concern. But to avoid it, what we typically do is we move the property into a trust. So you do see, because it's public record when the ownership moves, right? But if you deed it into a trust, they typically won't call it due because it's for estate planning purposes. That's usually what you use a trust for. So this is just one strategy to do that. And then the way they get tipped off typically, Zach, is through the insurance. So you don't want to cancel the insurance payment. It doesn't matter where I would just write, everything's auto draft now anymore, but I would just write a check and send it in, and it didn't have the seller's name on it, had my name on it. I've never had an issue with it at all, but I would always add myself to the current insurance policy. I would never cancel and buy a new one.
Yeah, that's a good tip. I mean, that's what people always say is keep the insurance the same. It might be escrowed through the lender as well, but add yourself as an additional assured. I mean, that was not going to matter to the lender. I've also heard of people putting it into a management, like having a management company be the LLC, and it's just management name, and then going through a servicing company to start paying the mortgage if it's not auto drafted. I have my property manager pay all my mortgages for us from a bank that has nothing to do with and I'm still entitled for those. But I mean, the point is that like they don't care, like they've never seen that. Plus, right. The same thing would apply with the majority of our investors, which transfer that buy using conventional financing, own in their name, and then transfer to an LLC, and just for liability protection. And there's never any issues with that. But Adam, I'm getting deep on my tangent, so bring us back here.
You talked a little bit ago about, getting into the financing side of things. What are some, if someone is interested in that side, like how did you educate yourself on that? And what are some important things to keep in mind whenever you start being the actual bank that people are utilizing?
Yeah, so I started bringing in private capital and hard money loans and that kind of thing when I was doing flips. So this wasn't, maybe I was about 6 or 7 years into my career at this point. And so I started learning more about this business, but I wasn't in it. I was the one borrowing the money. And then I ended up getting recruited to be a mortgage broker. This is back before the SAFE Act, right? So back before the crash in 2008. And so I started just originating normal loans. The interesting thing is, though, as we started progressing through that crash, it became so challenging to originate loans. And I would go to someone like maybe you guys and say, hey, you're approved for your dream home. Here's your pre-approval letter. I got the lender to agree to it. You go out and find it. Maybe it takes you 4, 6, 8 weeks to find a property. And now you call me, say, I'm ready to go. And it's like, oh shit, let's rerun this. Guidelines have changed. And you know what? You're no longer approved. So I'm like, I felt like I was crushing dreams instead of like empowering people, right? So I decided to take control of the business. I didn't like the fact that somebody else would make the decision for me. So I started raising private capital. And that was, this was all 2006-ish is when I started raising private capital, but I really started focusing on it after the crash. Pine Financial was started in 2008. And I don't know if I'm answering your question, but we have 160 million under management now, and we work in a handful of different states. And it's great. This is a great side of the business because you can't close on transactions without the financing.
Yeah. So if someone is going into, and starting to do the bank, kind of, do you have any tips for things to avoid and, kind of people who you want to focus on or anything like that?
Yeah, this is a fantastic business. Anybody has some extra cash and they just want to loan it to somebody else. Look, you could charge points, you could charge high interest rates. There's a demand for this money, so it's very lucrative. And if you're doing it right, it could be extremely safe. Now, you could screw that up, so you need to be careful because if you make a mistake, you could potentially risk your entire investment. And I've seen that happen, especially with like not recording liens or going into a junior position and not having the ability to take out a first. If you're going to a junior position and you don't have the money to pay off that first loan, you don't have any collateral at all. If that first starts foreclosing, you just get wiped out, right? So I've seen some mistakes like that. So to answer your question, we created a report to help people that want to get into this business on their own. You could work with someone like us for sure. But if you want to go out and do it on your own, I just don't want to see you get hurt. So we wrote a report to help with some of those common mistakes. It's thepinereport.com. They can get that for free. So I don't know if I'm able to share.
Yeah, a lot of
it.
And we'll definitely put that in the show notes as well. But let me jump in here as well, Kevin, to share a little bit of my personal experience, and then I want to look at it from the other side for investors that are looking to raise capital as well and advice for them.
Yeah.
But if you're an investor that's looking to place capital and be the bank and lend it out, it can be easy, but man, that can also be high risk, right? Because what you could potentially lose is all of your investment.
That's right.
And sometimes people don't make that abundantly clear. Like that is an option. That is a potential, right? And that's why I do like having physical real estate, because in most cases, like if you own the real estate, it'd be very difficult to lose all of your investment, right? You at least have insurance if the house burns down, you have a physical asset, things like that. And I'm not saying it's not right. I act as a private lender. I have in the past. I've lost 7 figures acting as a private lender, making some of those stupid mistakes. And the biggest thing I would say is that when you're doing it safe, I'd be interested to hear if you have anything else to add here, Kevin, but make sure the asset is secured, meaning don't just give someone money with the promise to do something. You can have a PPM, you can have a personal guarantee, you can have all this, in writing, but if you don't have if you don't have it secured, meaning it is tied to an actual asset, then it's unsecured. And unsecured lending is the most risky thing you could potentially do. And even if it is secured, you got to look at recorded liens. I had this one gentleman, which that's a stretch to call him that, but he had a first mortgage on a property, and he went out and raised a bunch of seconds. And so he collected like $10 million on a property that was worth $1 million. You know what I mean? And so that foreclosure, by the way, is still going on 4 years later. And we'll see nothing out of it. But like that's just something to be conscious of looking at who you're working with. You can run background checks on people. That's really important to know who you're working with. But it's the operator, the project, knowing what the project is. Sometimes when you're an early investor lending money to somebody, and if you're looking at a syndication or whatever, you may not have the experience level to underwrite the deal, and that may be a bigger thing. So in some cases, it's more important like who's the operator, but also try to underwrite the deal a little bit would be my opinion, but also make sure you have some sort of security and start small, right? If you're going to lend money to someone, have them prove it to you and pay it back first. That's my personal opinion. Actually go through a transaction with them and have that come full cycle. There's a lot of syndicators out here and people that are syndicating for other syndications, and this whole level up that you don't even know, they're not even attached to the property, and they're raising capital to lend to someone else. It's like, well, who am I actually lending money to at the end of the day? And what happens if this goes south? And have you done, the best question I would say to ask is, have they done any deals that have come full cycle? Well, no, we're in our third deal right now, but we're in year 3. It's like, wait a minute, you haven't paid back investors their money to actually have a full IRR. There are so many deals out there, and you probably know this and can speak to this, Kevin. You've been in business since 2008. If they haven't had multiple deals come full cycle where the investors got all their money back, they have not had a proven track record, in my opinion, right? If you're locking, specifically talking about syndications, if you're locking your money up for 5 to 7 years, that's a long ass time. And you got to really look at the full picture. And guys, I've been there and done that. And guess what? I've been to the year 6 and 7, and I received monthly payments every single month on time. And then it comes time for payout. And guess what? To come to find out, the operator's like, way underwater on the property and it's up Schitt's Creek or whatever. But I mean, this is just something I digress, but you got to be cautious. Is there anything else, Kevin, you would be conscious of for someone who's just jumping into the private lending space, of how to vet opportunities, operators, or things to be conscious of to avoid losing potentially all their money?
Yeah, no, I love everything you're saying here, Zach. And what I will say, if you're doing this right and you're being smart about it, I believe sounds like it might contradict your opinion. I believe it's safer on the debt side. You're not going to have the high returns if you own the property. You're going to have a much higher return, especially over time. So if you're shooting for highest returns, buy the house. Yeah, but if you're looking for very stable and very secure, I think being the debt investor is safer. But you can't go unsecured like you're describing. Or you got to make sure that the insurance that's in place is the correct insurance. So to answer your question, another mistake I see people make is the insurance. They'll get like a landlord policy, for example, and they're doing a fix and flip. Well, the problem with that is the landlord policies, all of them, 100% of them have a vacancy clause. And the vacancy clause in the policy says something like this: if it's vacant for 30 days, sometimes 60 days, you don't have any insurance. And the reason for that clause is because vacant properties are higher risk. Think about it. You got vandalism, you got contractors on ladders with power tools, or do you have a family living in the home? Which one's less risk, right? So a lot of times investors will go out there and buy the wrong policy because it's cheaper premium, and then they don't have any insurance at all. So that's another one that I see people making some mistakes on, but definitely the not secured or undersecured, meaning you're in a second position or the loan to value is too high or something like that. Those are the highest mistakes. Hey, let me take one more back. Our biggest reason we see defaults, because we re-underwrite when we get a default, is lack of liquidity. So look, we'll finance 100% of your transaction if the deal's strong enough, but that doesn't mean that you shouldn't have any money.
What do you require on liquidity? Like, can you quantify what a good liquidity amount would be?
And we honestly should be higher than this, but our requirement is 10% of the loan amount. So if you're buying you're borrowing $200,000, you need $20,000 in the bank.
I've literally had to raise capital from a select few private investors because I've had some of the banks that I've bought commercial properties with, they required me to have a liquidity covenant, which was 10% across all contingent liability. It wasn't even that particular property.
Yeah, that's
even my primary residence. And like, that was really a huge obstacle for me because I needed to raise money to literally sit in the bank. I mean, and we have a large 8-figure portfolio at this point where it's like, we're talking millions of dollars just sitting in the bank doing nothing. Fortunately now there's higher interest rates on some of those, but anyways, I got a lot of tangents today, Adam.
Yeah, we just closed a line. We just closed a line with a bank for $20 million, and they have a 15% liquidity requirement in their bank.
Yeah, usually it's held with them. They want the money there, right? That's the benefit to them. Let me ask you this on the flip side, because we were kind of going down this path, Kevin, with people that like scalability is one of the biggest things. A lot of our investors, as all of us do at some point during our investing career, is we hit the capital brick road, right? Or brick wall, where there is, we spent all our down payment on properties, and we're like, okay, this is great. I have a handful of doors. I want to continue to scale. I've looked in other resources, like maybe self-directing an IRA. I've looked at taking out a HELOC on my primary residence. Maybe I haven't explored student loans to invest, but now I will because Kevin told me to. What is, for someone that's looking to raise capital from other people, what advice would you share to them as they're getting started about how to attract people or how to raise capital for someone that's either going to lend them money or be a deal partner to help them scale?
Yeah. So to answer your question, I'm going to start with this. You should go to private individuals and private equity last. That's going to be your most expensive. So if you can take down institutional capital, do it. So it sounds to me like you hit your limits because you're saying 10% across your portfolio. That's only a requirement after you hit a certain amount of like Fannie Mae loans. And now you have to go to the commercial world. Right? But if you can get Fannie and Freddie debt, this is 30-year fixed rate debt. Do that. That's the best financing you're going to get, even in this environment with a little higher interest rates. So I would.
What about someone that's done that though? They have 20% down payment. They're out of those down payments. That's who we're speaking to.
Yeah. So you could leverage other properties first. I'm a leverage guy. I think you could do it smartly, but without leverage, you're never going to reach your potential. So leverage creates growth. In fact, you said at the very beginning, one of the things I didn't mention about real estate is the ability to leverage, right? So I would try to pull money from other properties first, and then I would go to private capital. So let me give you an example. There wasn't a liquidity issue, but I definitely had a credit issue that was preventing me from scaling back in 2010, 11, 12, when everything was on sale, right? We were buying stuff at 30 cents on the dollar, and it was just in the MLS, right? But I didn't have good credit because I just went through 2008 and 9. So I pretty much lost everything, except for my lease options, which I mentioned you could reduce risk on those or eliminate risk. So I still had all of those, but I was losing everything. But I didn't want to pass on these opportunities I was seeing. So I was bringing in partners to sign on debt with me. So I would do all the work, find it, manage the rehab, get the tenant in there, manage the tenant, and I'll take 50%. We're going to go out and have you sign on any mortgages, any liability. So you'll own it, and then I'll deed my company into it, or we'll deed it into an LLC that we both own, or however we wanted to structure it. But you could do the same thing with down payments, right? The problem in the residential world is if you have a down payment from a partner, they have to sign on that liability. In the commercial world, you don't have that. So I would say you need to offer something attractive for them to bring in the cash and their signature for them to want to get involved. Is it 50% of the deal? I don't know. I mean, that's a tough one to answer because each deal is so different, right? I guess my advice would be start talking to people and seeing what the demand, what they're going to demand, what they want, and then try to craft a scenario that meets what they're looking for and you could profit from.
It's almost comparable to what you were talking about previously in helping out sellers in creative finance, right? Of solving their problem with either sub 2, lease option, seller finance. They have an issue or they have a goal that they want to meet. Well, raising private capital is not that far off, where you have people that also have needs, right? And you just got to find out what those needs are and how you serve them. There's a lot of people that have money that, they may be earning 4 or 5% in the bank right now, but that may not be enough for them, especially with inflation. Maybe they want to own real estate, but they don't want to do any of the heavy lifting. They don't know how to get started. Maybe they just want to build a diversity in their portfolio, or they're 100% in stocks and they want, you could be the solution for them. maybe they need tax benefits, right? Maybe they're a high income earner and they need some additional tax benefits, and you can show them the light, because guess what? It looks like Congress is re-upping our 100% depreciation, which Adam is just, celebrating so much because now he's doing accelerated depreciation on his properties. And we, of course, love that strategy. Yeah. Would you agree that that's solving problems on, the private money lending side?
Well, yeah. I mean, it's just sales 101. You got to find out what the problem is and then solve it, right? And so if you have an investor that has a tax problem, that's a perfect solution for them. I love it. Now, when I say on the commercial side, they need to sign, on the residential side, they need to sign on debt. That's true, but that's conventional, right? You could do commercial debt on residential properties. I don't think everybody understands that. So you could potentially bring in private capital for down payments and avoid a personal guarantee on debt if you go to a commercial bank that's willing to look at that.
Know what financing options are. Yeah.
There's a lot. It's just so vast. Literally more than you could even comprehend different ways to structure your deals.
Yeah. So let's go from this into a little bit broader spectrum as we kind of come closer to the end of this. But what, we've seen inflation come down a little bit. We've seen the Fed come out and talk about, now the question is when they're going to cut. What are you expecting to see happen in the world, and how is that going to impact kind of the sides that we've been talking about? Like if you're doing the lending, if you're the one doing that, how is it going to impact that world, if it is at all?
It's an interesting question because there's no correlation that I've seen between mortgage rates or the federal funds rate and private money rates or hard money rates. They just don't align. So hard money is priced by supply and demand, which a lot of things are. So as long as there's a demand for the money, the pricing is going to be high. So the question is less about the inflation and the interest rates and more about the credit tightening. So we have severely limited credit availability right now. I don't know if you guys have ever seen the Mortgage Bankers Association Credit Availability Index. You guys should Google that. It's phenomenal.
It's a mouthful.
It's pretty amazing. So it's the index. So it just shows like how easy it is to get credit and how ridiculously low it is. And it popped up a little bit in 2019, but it crashed again in 2020, of course, with COVID. But right now, and this is for the foreseeable future, well into 25, I would suspect, banks aren't going to be lending. It's just difficult. It has to be almost perfect. Now, the interest rates will impact that a little bit because you have debt service coverage ratios, which is the amount of income a property produces and can it afford to pay the debt. So that will loosen as interest rates go down. But outside of that, it's highly qualified borrowers. So that's going to drive the pricing of hard and private money up. So back to what you were saying, Zach, if someone's got some money sitting on the sideline, private debt isn't a terrible place to be when there's tight credit like we're seeing right now. So I'm trying to tie your question in about the economy into what we're talking about here. But it's really supply and demand and less about inflation and interest rates. But what I will say is the Fed has been very clear. This is very different than what we've seen in past chairs. Powell is definitely being as clear and concise as possible because he's very protective of like the stock market, for example. He doesn't want that to crash. He's being very transparent, which we haven't really seen before. But everything that he's saying is what's happening. And he's clear. 75 basis points in this year is what he expects. Now, can that change? Of course. But you know what the experts are saying? 150 basis points in 2024. So now you have the stock market anticipating, 3 half-point moves in the interest rate, and they're building that into the valuation, which scares the crap out of me because there's so much volatility in the stock market, which is why I love real estate. That's not going to impact it, but it's definitely built into the stock market. And I would suspect when that doesn't come to fruition, we'll see some type of correction.
Good points on the mortgage side too. I don't think we've had someone that's really talked about like what lending potentially looks like. And you probably will if you're, using the conventional loans. I think that it'll probably still be the same underwriting criteria for that. But certainly when you get into, we've seen this every single year. It changes. And actually during COVID, a lot of times, like lending shut down for a lot of time. Like we literally could not get a loan for a good 6 months there on commercial assets. It didn't matter how good we were or if we were bringing 50% down. It's just crazy how dynamic the lending world is and how that affects the transactions of deals and, residential. To your point, there's a lot of people that I mean, especially once you get past the 4 unit, the average investor, what this may mean for you is that, I mean, we already know that there is an undersupply of inventory, and that's part of the reason the market hasn't overly corrected over the past 2 years. We still have a shortage and a low inventory of housing, and while interest rates are coming down, that makes it better for the average investor, but it still may be somewhat challenging for debt for the the more institutional buyers or the larger scale buyers. That makes it more relevant in the private lending space, in the creative finance space, and might be a unique niche for the average investor if you're still have access to those conventional loans to scoop up deals that other people cannot, because you can make those loan terms work for you. And obviously the attractiveness of debt with the interest rates coming down might be more beneficial for you. But that was kind of a mouthful to say. 2024, I mean, still is an attractive year, like all years, to still buy real estate. You just have to know how it makes sense and what your strategy is. I guess, would you agree with that, Kevin?
I couldn't say it better. I mean, I mentioned I'm a little concerned about the stock market, which is true, but I'm not about real estate, especially housing. Now, I am a little bit on commercial, and that's for a different episode. But housing, the shortage, I don't see an end in sight. We just are so far behind on new construction. And I get the argument, oh, baby boomers are going into homes now and they're dying off, so we're going to have all this inventory hit. Well, that's not true. Because what's happening is that wealth is transferring to millennials. And millennials are in the prime first-time home buyer. And that cohort is 25 years old, right? So they're the first-time home buyers. So all this wealth is transferring to them. What are they going to go do with it? So I think, and that cohort, by the way, is larger than baby boomers right now. So I think that's even going to hurt supply further. So I don't really see a way out here. So I think there's a lot of stability in real estate values. So again, coming back, I just feel very comfortable in this space.
Yeah. So one of the questions we always like to wrap up with is, you're looking at, you meet somebody on the street, they're interested in real estate investing, but they haven't actually taken the plunge. You're talking with them. What are the things you're saying to them right now to kind of push them over the edge and be like, yes, this really is the way that you are going to be successful in your journey?
Yeah, I guess it depends on what they say, but if their argument is I'm waiting for the crash, because you hear that sometimes, right? I'm going to buy when the market softens. Well, we've been hearing about this crash for 15 years. So when is it coming? Are you going to sit there on the sideline for another 15? I think the best time to buy, what do they say? The best time to buy was yesterday. The next best time is right now. I think you can get into real estate and do well no matter what time or when you do it. But I would say be careful for your safety to buy on cash flow and not speculation or appreciation. So make sure that you could hold that thing for a long time so that you could weather any storm. So if it's cash flowing, you can hold it forever, right? Now, as far as getting involved and how to get started, it starts with education first and then overcoming fear, because the fear is what stops people from taking any action. And without taking a step, you're going to be the same spot you are right now 5 years from now, right? So figure out how to overcome that fear and actually go out there and start making offers. I guess that'd be the best advice I can give. But the fear thing is a very interesting topic. And one of the ways to overcome that is full circle here, is coming back to your why. If that why you want to be a real estate investor is big enough, that fear won't stop you.
And education, I think that the biggest thing, if you have the fear of the unknown, well, make those unknowns known and find out answers to those questions and have a baseline understanding that at no point you're going to understand everything. Like, that's normal, right? Real estate journey is a lifelong journey.
Yep.
And you'll never have all the answers, but certainly if there's the big obstacles, identify what those are, and then educate yourself on those items. And that's what we're here to do, is help you. And I know Kevin, you shared the same message there of education for people is, and offering solutions for them is the way to overcome those fears. So
totally. And build your team. I mean, that's I should have mentioned that. You got to have a good team around you. So start going to the RIAs and start meeting people. But yeah, educate. Listen to podcasts. Don't listen to music. Listen to podcasts like this.
Absolutely. Well, the website for Kevin is pinefinancialgroup.com. That's pinefinancialgroup.com. Tell the listeners a little bit about what they're going to see when they go there.
Yeah, so we have two sides of our business. We raise private capital, as I mentioned, so we operate some mortgage funds. So similar to what you were saying, Zach, it is a syndication because we're bringing all the money together and we go out and make loans. The cool thing about real estate is it's the most transparent asset there is. So you could go in and see, yes, this fund has a lien on this property, right? So it's super transparent. It's not like a mutual fund or, like the Ponzi stuff that you hear about where you don't know where the money's invested. This is very tangible. Or the borrower side, if you're looking to do fix and flips or new construction, we do some commercial value add or repositioning. So you'll learn more about how to do that. And then I want to mention the other website, the pinereport.com. That's the one that has the report on the private lending if you want to get into that. But it also has a second report on there. So there's just 2 reports on there. The second one is about the 1990 housing crash compared to what we're going through right now today, because this doesn't resemble 2008 at all. And we can't compare it to 2008. So
will you talk on that real quick? Because no one's brought that up. So how does this compare to the 1990?
Well, we had hyperinflation and high interest rates. So it starts with there. And it actually doesn't even compare that much with 1990. But here's some of the examples. So we had the high interest rates, coming out of a conflict. There was tremendous government spending, which drove up interest rates. So we've come out of COVID, tremendous government spending. So now we have not interest rates, inflation. So same cycle, right? Now we have high spending and now we have high inflation. So how do you fight inflation? Well, you got to pay that back. You got to pay that money back. The way we pay government spending back isn't through taxes. It's through inflation. So it is a tax. We just all pay the same amount. So it's really the most fair tax that there is, right? So now we have to pay this spending back through inflation. And that's what we're doing right now. But then you also you came out of the savings and loan crisis, right? And if you look back to last year, it was in March of last year, we started seeing the banking sector a little fragile, right? We saw, in fact, the 5 banks that collapsed amassed their assets under management was larger than all the banks that collapsed in 2008. So assets under management was a larger collapse last year than we saw even in 2008 with Lehman and Bear Stearns and those big boys like that. So savings and loans, now we saw Silicon Valley Signature and these other banks go down. So there's some similarities there. And one of the biggest similarities is, this isn't a similarity, but one of the interesting things about recessions, if you go back, it typically doesn't impact real estate at all. You might even see real estate values go up in value in a recession. So I think that was interesting. When I was doing my research for that and I noticed that, I found that very interesting.
So just bear with us a little bit longer on this topic here. Based on the similarities that you just identified and where we're at now, what are you projecting? Are we looking at like mid to late 90s of similarities in the market? Is it completely different? Nobody knows. Draw a conclusion on where you think we're headed, Kevin, now for the next 5 years.
Yeah, well, I think I've already done that because I have a lot of confidence in housing. In 1990, the decline in values was about 14% across the nation. And we've already seen a decline nationally. We're just past that now. We're already gaining most of that back. So I think we might have already gone through the recession. We just didn't call it that because unemployment's low. But we've already seen all the inverted yield curve, the high interest. We've seen everything else that would identify a recession, the 2 quarters of negative GDP, right? We saw that. They just don't call it a recession anymore. Well, because it's an election year. Maybe that's why.
Yeah, there's a lot of arguments, about that. And to be quite clear, one thing that we've seen for the first time in about 2 years is builders starting to increase their construction prices dramatically, on average between, 9 to 14, some as high as 14%, like our Alabama builders. So that has been, where we saw a slight decrease in pricing and stagnation in pricing. We're actually seeing a routine increase in new construction, which we haven't seen for a while. So I would agree with you 100% on that.
Yeah, and it's high confidence in new construction now. That's just coming back around, right? There was low confidence, and now it's much higher. But I think it's because of interest rates are supposedly going down.
Yes.
So, but I am worried about, finish up on your question. I am a little worried about banking, and I am a little bit worried about the commercial, certain classes in the commercial real estate. I think we're going to see some pain in those 2 sectors.
All right. Well, Kevin, thanks for joining us today. Really appreciate the time you spent with us and our audience. If y'all have any questions that you want us to run by Kevin, or if there's any questions you want Zach and myself to answer in future episodes, send them to podcast@renttoretirement.com. That's podcast@renttoretirement.com. And don't forget to check out our inventory over at renttoretirement.com. That's renttoretirement.com. Again, you've got pinefinancialgroup.com and thepinereport.com to get those 2 reports that Kevin mentioned earlier. Really appreciate the time you spent educating yourselves today. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.